Starhill Global REIT's quarterly update dated 27 October 2023. Okay, so they have a portfolio of 2.8 billion, right? Basically 9 assets, mainly retail in 6 Asian Pacific cities, right? Their sponsor owns quite a big proportion of the REIT, which is quite rare in the REIT world, I think, right? So having this alignment of the sponsor with the shareholders is a good thing. So generally, a sponsor that owns a large proportion of the REIT will take care of the shareholders because he's essentially taking care of himself lah. So this is a good alignment with shareholders, right? They have landmark assets, mainly Wisma and Taka, right? So yeah, they have high occupancy commitment, and also their gearing is relatively well managed lah at 37.4%, right? So revenue is down 1%, net property income up 0.4%, high occupancy, long WALE, gearing is relatively well managed, and they are saying here they have actually enough revolving credit facility to cover debts in the next 2 years. Right, so financial assets, financial highlights, mainly the 1% drop in revenue is due to forex weakness and the loss of income from the Japanese divestment, so that they divested some Japanese property, right? So higher contribution from net property income is mainly due to Singapore properties and this Australian property, right? So Wisma Atrium still has some asset enhancement work being done, but generally the shopper sales and traffic has improved, right? You can see that this is more or less the invert of the last REIT that we saw. I think it's CICT, that the sales increased by 14% and the traffic increased by 6.5%, right? So I think probably this shopper traffic is the high-end traffic, right? So if you look at that area, generally I think the products that they sell there are very high-end and they cater to the rich people. So I'm not so that surprised that the shopper traffic increase less than the sales, right? Which is opposite of CICT. And if we look at what they're doing, they're trying to extend a yen loan, right? Which I think is a smart thing to do. Like if some of the REITs have properties in Japan, right, they actually can maximize their Japanese yen borrowing, because the Japanese yen is still at a very low interest rate of less than 2%, right? It's like 1 to 2% interest rate. You compare elsewhere in the world right now, I don't think you can get anywhere near that kind of low interest rate. So I think a lot of REITs, like for example MIT, which is the last REIT we saw, that is trying to get trying to maximize their Japanese yen loans, right? And then they're trying to pay off their other loans in SGD or USD, for example, right? So anyway, moving on, we want to see which are the properties that are performing, right? If we look at year on year, right, this is the latest year. So Ngee Ann City is going up, right? Wisma is also going up, right? So the Australia properties are the one that is underperforming slightly, and also the Malaysian properties, right? I think the others is China and Japan, which are too small to worry about. So net property income tells roughly the same story. Wisma is going up, this Ngee Ann City is going up, Wisma is also going up, and Australia is going up as well, and yeah, Malaysia is going down. Right, so NPI, there's an explanation here, mainly higher contribution from Singapore properties and Maya Centre Adelaide Retail, which I think is an Australian property, partially offset by depreciation of foreign currency and loss of income from Japan divestment. Right, so the debt maturity profile I think is okay. Generally interest coverage ratio is 3.3 times, right? If you want to adjust for distribution, it's 3 times, right? So it's actually in line with some of the bigger REITs that the weaker interest coverage ratio REITs that we've seen lately in that comparison video of their debt profiles, right? But their gearing is slightly on the lower side lah. I actually wonder about their hedging ratio, right? So they either fix their debt or they hedge their debt at 77%, but actually this number is lower than their previous number, because I look at their annual report, which was dated 30th June 2023. This info is dated 30th September 2023. It was actually 84%, right? So actually the amount of debt that they hedge actually dropped. I'm not very sure why. Yeah, so it could be that some of their their interest rates swaps have expired or something. Yeah, maybe some of their hedging has expired, so that's why I understand that it's actually quite expensive to hedge your debt lah. So that could be one of the reasons why they are hedging has of the interest rates have dropped. Right, so we look at why actually I think Singapore is the main focus. You can see that 70% of the asset value in Singapore, and in terms of revenue, 62% is from Singapore. So yeah, I'm not sure what to make of the fact that the asset value is much higher in Singapore as opposed to the revenue, right? One way to look at this from just the Singapore perspective, I suspect, is that perhaps the revenue in Singapore is not so good in recent years due to COVID. But I think the same could be extrapolated to Australia and Malaysia, so I cannot be certain that I'm correct. Right, so yeah, you can see that this is mainly a retail mall lah. 85% is retail, right? So there's a part of the office there. You can see that generally occupancy is high across the board. Don't really have too much to say about this slide, right? I think one of the issues is that there's a concern here about the Toshin master lease that is expiring in FY 24-25, right? We need to see how this renewal actually goes, right? Office wise is quite well spread out, right? So again, just the Toshin master lease at Ngee City is a bit of a concern, right? So outlook, I think the same issues arises lah with every other REIT. Geopolitical tension, high borrowing costs and energy prices. Global growth is a worry. For Singapore, I think it's roughly it's sort of we expect some growth, but the growth isn't going to be that great. But I think for Starhill Global, one of the main hopes we have is international tourists coming back, because they are very high-end kind of shopping center that caters to the very expensive product. So actually, I think a large part of their income for sales comes from tourists that bother to visit Orchard Road to spend that kind of money. I don't think locals in general go there too much lah. They could, but I mean, I could be wrong, because maybe they're rich Singaporeans that go there to buy things, but I do think that a good part of their sales and traffic actually come from overseas. So with the tourism expected to recover by 2024, there is hope that actually Starhill Global's matrix will keep improving moving forward. Right, I looked at the annual report because there wasn't much in this presentation slide. The annual report was dated end 30th June 2023, so it was just 3 months before that present business update, right? So I just went to have a look. In terms of DPU, not much to say. I'll tell you what's interesting about DPU later and why I'm quite interested in this REIT. Alright, so anyway, this one, they're just saying that they invested this property in Japan, right, which we discussed earlier, right? Then they had access to this Australian property, and there was upgrading at Wisma Atria, right? So I think this is the main reason why I'm interested in this REIT. If you look at generally how REITs recover, normally the big REITs like the Maple Trees and the Capital Lands, they will move first, and then later on the smaller REITs, like I only look at what I consider to be better managed REITs, and I think this is one of them. That Starhill Global is not a bad REIT. It's just that it's a little bit small, and maybe the bigger institutes can't afford to look at them, because you will not basically, if your funds that you manage is too much, right, you cannot invest in the smaller companies, and this is one of those, I think, smaller companies that fly under the radar. I'm not saying this REIT is perfect. It has its issues over the years, like its master leases. I think they had some issues in, I think 7 years ago, with I think Toshin as well. Yeah, they were trying to renew it and it got a bit messy, right? If I'm not mistaken, I cannot remember correctly, so don't quote me. I think there were a bit of legal issues involved as well. But if we are looking at the current price of 47 cents and DPU, if we take it, the last 2 years of DPU is relatively constant, and it will extrapolate to this year, the yield is actually 8.1%, which I think is quite good for a REIT that is of this kind of nature lah. It looks like an opportunity to me, right? However, please note that this is not financial advice lah. This is just me talking to myself about what I think are interesting ideas out in the space right now. Right, so anyway, moving on, occupancy rate is I think decent. Net asset value is something interesting that is sloping down. Right, we'll see later why this number is actually less. Right, there's an explanation later. Right, so they actually explain why the group portfolio value declined here by 4.6%. Right, so the reason they say is because of downward valuation of the Australian properties and Wisma Atria property, the retail side, as well as some divestment. Right, divestment is to be expected lah. The property asset value will drop, right? But I'm a little bit surprised Wisma Atria is revalued downwards. Okay, so hopefully with the changes in the uh, tourists coming down, I think uh, Starhill Global should be one of the big beneficiaries lah. Right, so with that I'll end the presentation. Thank you for listening.